Hi, good afternoon, everybody. We are coming to the last session of today's webinar. In this session, I will share with you our market outlook of Hong Kong and China in the fourth quarter. Okay. These are the key discussion points today. We'll do a review of China and Hong Kong stock market in the third quarter year to date, and then we'll go through the overview of China's economy and the fourth quarter outlook. Then I'll share with you our index targets in the fourth quarter and also some of the ETF picks. This time round is a lot of attention focusing on China tech stocks. So, but because the policy risk is still uncertain, there's still uncertainty stemming from policy risk and also the business outlook. So we'll focus on the technical analysis side to forecast the future price performance of those tech stocks. Okay, the third quarter for Hong Kong market is a turbulent third quarter. There are quite many headwinds in the third quarter. For instance, concerns about persistent inflation caused by rising raw material prices. And then these supply chain disruptions continue because of the COVID-19 pandemic. Another new uncertainty arising is Fed tapering. So minutes from the Fed shows that it's very highly likely that the Fed will start reducing the purchase of bond purchase starting from next month. And then the Fed may hike rate as soon as end of 2022. The previous projection is 2023. Okay. And the other headwind that the market is facing in the third quarter is the power crunch that occurs in China, which is still not being solved at the moment. And then together with power crunch, the market is also rocked by the default fears about Evergreen default fears. And also recently in certain parts of China, for instance, northern China, there is severe flooding, which will cause disruption to mining and manufacturing. Okay. The Shanghai Composite Index was down 0.6% in the third quarter, but for the first 3 months of the year, it was still up 2.7%. Actually, it had a rather good performance in September, rising to a high of 3723, which is close to the peak seen in February. Yet it cannot sustain above 3,700, and recently it corrected to below 3,600. Our previous forecast for third quarter, the index range, we forecast a range of 3,640 to 3,450. The actual peak and the trough in the third quarter is actual range is much wider than our previous forecast. The Shanghai Composite Index rose to 3,723 and then also saw a low at 3,312 in July. Okay, this is the range, the index range in the third quarter. Last time we offered 2 ETF picks. One is on A50 and the other one is on CSI 300. The ticker 2822. We recommend to buy at 1840 and we set a target at 2150 and stop loss at $17. But its share price corrected from it only rose to $19.72. So they're still below our target price. If investors bought at 1840, they would have cut loss at $17 because it went down to a low of $16.50 in the third quarter. Yet the loss, it may only suffer a less than 10% loss on this strategy of buying at $18.40 and cutting loss at $17. Okay. As for the other ETF, 3188, in the third quarter, it went up to 63.24. It should be third quarter, and saw a low at 55.86. We recommend to buy at 59 and stop loss at 55. So those who have bought at 59, since it had not hit the stop price at 55, the low was only 55.86 in the third quarter. So we will suggest to continue to hold the ETF unless it breaks below the support level of $55. Okay. The Sunshine Composite Index fare not as good as the Shanghai Composite Index. It was down 5.6% in the third quarter and was down 1.1% in the first 9 months. Okay. The Chinex index performed very well in the first half. Yet in the third quarter, it also saw a correction from close to 3,600 to currently below 3,300. So in the third quarter, it was down 6.7%. But for the first 9 months, it was still up 9.4% because in the first half, it rose about 17% in the first half. Okay. The Hang Seng Index underperformed the Asia market, Asia Index throughout the year. It was down 14.7% in the third quarter, partly dragged down by tech stock sell-off. In the first 9 months, it was down 9.7%. So you can see that the downtrend is still intact for the Hang Seng Index. It fell from a high of 28,859 around July. It fell from a high of 28859 to a low of 23771 in September. Actually, it saw a new low in early October to around 23,680. But since then, it has rebounded to around 25,000 at the moment. Our forecast quite we are being a bit too conservative in our previous forecast. We forecast a range of 27,700 to 26,000, but the index was fared worse than our expectation. It went to a low of 23,771. So our forecast was not so accurate in the second quarter. Our previous ETF pick was the Tracker Fund, the ticker 2800. Its high low was $29.24 in the third quarter and $24.44. Our recommendation last time was to buy at $26.20, and we had set a target of $27.60 and stop loss at $25. However, because of the downtrend, actually, after investors bought at $26.20, it did not rise back to $27.60. So unfortunately, investors who adopt this strategy may have to cut loss at $25. Yet the expected loss is around 5 to 6%. We are being quite conservative in the second quarter. So we recommend a very tight trading range as well as a stop loss price. Okay. The Just now I mentioned the Hang Seng Index was dragged down by the sell-off among tech stocks. The Hang Seng Tech Index, Technology Index, was down 25.2% in the third quarter. And in the first 9 months, the index was down 27.6%. So most of the decline was seen in the third quarter. Okay. It dropped from a high of 8,138 in July to a low of 5,770. The low was seen in August. Okay, so in September it did not fall to a lower level than those seen in August. Our previous forecast also is a bit too conservative. We are forecasting a range of 7,800 to 6,800, but actually the tech index saw a much wider range in the third quarter this year. Okay, for last time we picked two ETFs, the CSOP Tech ETF 3033 and the iShares Tech ETF 3067. Our recommendation was to buy at $6.90. $6.09, target $7.70, and stop loss at $6.40. It went down to as low as $5.73. So those who bought at $6.90 would have cut loss at $6.40. Yet the loss is within 10%. Okay. As for 3067, we recommend to buy at $14.50. We set a target of $16.30. Although the high was $16.99, but it occurred before this buy price. So actually, those who bought at $14.50 would not have been able to sell at $16.99. But it also hit the stop loss price at $13. Because it went down to as low as $12.07. So the loss for our last ETF strategy was about 10%. Will result in about 10% loss in our recommended strategy on 3067. Okay. So this part will share with you the overview of China's economy and the fourth quarter outlook. Okay. The economic downside pressure was intensified in the third quarter. In the first half of the year, China's economy grew 12.7%. Yet we saw a moderation of growth in the growth rate, GDP growth rate from the first quarter to the second quarter. First quarter GDP grew 18.3%. In the second quarter, it moderated to 7.9%. China will release the third quarter GDP and other economic data next week. So it is expected to slow down further to about 5% in the third quarter. GDP growth is expected to slow down to about 5% because of the headwinds we saw in the third quarter. Okay, the moderation in the in growth rate in the second quarter is attributable to a higher base for year-over-year comparison, as well as a resurgence of COVID-19 cases seen in August this year in some areas in China. But taking the past 2 years together, the annualized average growth rate improved from 5% in the first quarter to 5.5% in the second quarter. Okay, we saw slowdown in the key economic indicators, including the fixed asset investment, retail sales. For fixed asset investment, the first 8 months growth rate slowed down to 8.9% from 10.3% in the first 7 months. Partly dragged by slower growth in real estate investment. Real estate investment growth rate slowed down to 10.9% in the first 8 months from 12.7% in the first 7 months. It was due to the central government's measures to rein in the property market, including setting upper limits on developers' debt ratios, the so-called 3 red lines, and also restrictions on purchases. Okay, we do expect the curbs to stay. Most real estate developers will look unlikely to meet their annual sales targets this year. In August, China's home sales by value. This is the first 8 months, but if you look at the single month home sales by value, it slumped 20% year on year, which is the biggest drop since the onset of the pandemic at the start of 2020. As a result, average new home prices also slowed down, growing at the slowest pace since December on a monthly basis, and since January on an annual basis. The reason behind is, as I mentioned just now, because of curbs implemented by the central government on lending, and also worries about developers' financial health triggered by Evergreen default, do deter house buyers. So a lot of investors are concerned about these Evergreen prices. Will it turn out, will it evolve into something like the Lehman Brothers event? Now, this is quite important because the real estate sector accounts for nearly 30% of China's GDP, and housing comprises 78% of Chinese assets. That's why, because of the importance of the real estate sector, the significance of real estate sector to China's GDP, China's economy, we believe China would intervene to manage Evergreen's collapse and ring-fence the problem. Okay, even if Evergreen, on a worst-case scenario, even if the government decides to let Evergreen collapse, we still believe that China's banking and financial system is robust enough and resilient enough to withstand a collapse if it happens. China will come up with policy response to handle the crisis, and we believe that policy response would most likely be timely and effective. There are several policy tools, including monetary and fiscal easing, that are available. Okay, for the time being, we still recommend against buying property developers, China property developers, because there's still uncertainty whether that bond default will also occur to other property developers. For the time being, we recommend to avoid the property sector for the time being. Does it have an impact on the bond market in China? We can see from this chart, this is the China High Yield Companies Index. So we saw a huge plunge because of Evergreen's bond default fears. It dropped by nearly 1/4 since May this year. However, the China Investment Grade Companies Index, which is the light orange line, was down only 2.1%. So actually, the sell-off is concentrated in high-yield bonds, or the so-called junk bonds, and it's not spread to the investment-grade bonds. Actually, foreign holdings of Chinese government bonds jumped in September at the fastest pace since January, ahead of their inclusion in the FTSE Russell WGBI index, World Government Bond Index, and as investors raise bets for policy easing to support slowing economic growth. So actually the sovereign debt market remains stable despite the sell-off among junk bonds in China. Okay, let's come back to the economic indicators. Just now we had gone through fixed asset investment, which has slowed down. Retail sales growth was far lower than expected. It grew at a disappointing 2.5% in August, a huge drop from the 8.5% growth in July. As China dealt with the worst outbreak of COVID-19 in August, since its initial spread in early 2020. Besides the impact from COVID-19, we also saw lower consumption in real estate related sales, such as sales of furniture, construction and decoration products, and home appliances as well, all remain weak. It's caused by the slowdown in the property market, which also trigger lower real estate related consumption. Okay, but there's a silver lining in China's economic data in the third quarter, and that is in the area of exports. Exports surged to record in value in September. The growth, export growth was surprisingly robust in September, as solid global demand offset some of the pressures on factories from power shortages, supply bottlenecks, and the resurgence of domestic COVID-19 cases. So exports jumped 28.1% in September in US dollar, value in US dollar. Import growth softened as domestic demand weakened because of higher raw material prices, so China imported less commodity in September. Because of that, China's global trade surplus rose to $68 billion in September from $52 billion in August. That was the highest level since 2015. Okay. Industrial output also slows down in September, growing at the weakest pace since July. Okay, hit by fresh COVID-19 outbreaks as well as supply bottlenecks. Industrial profit also slows down as industrial brace for the power crisis. Industrial profits actually slow for 6 months since the first 2 months this year. You can see the growth rate slowing to below 50%, as factories have to fight off high commodity prices, which pressurize their gross profit margin, as well as COVID-19 outbreaks in August, and also shortages of key parts, and with an unfolding power crisis, which threatens the future output and also bottom lines of industrial enterprises. Okay, China just announced the latest inflation data on Friday. The PPI-CPI scissors gap widens further. Consumer price inflation stays muted. The growth rate slowed down to 0.7% from 0.8%, very much impacted by the declining pork prices in China. Okay, and it was far below the government target of around 3%. So consumer price inflation was remained subdued. However, China's producer prices hit a 26-year high in September. It grew 10.7% year on year and 1.2% month on month, driven by roaring raw material prices. So the widening scissors gap, the gap between PPI and CPI, now there is a 10 percentage point gap between PPI and CPI, which implies in future worsening profit margins for Chinese companies. Is something to take note of. Okay. What's the picture shown by the PMI? The official PMI, the manufacturing PMI, dropped to the lowest level since February last year, as power crunch weighs on manufacturing activity. So it dropped below 50, once again dropping into contraction level. Yet the official non-manufacturing PMI returned to expansion as COVID-19 outbreaks receded in September. There was a resurgence of COVID-19 cases in August, but in September, we saw that the pandemic the outbreak was under control. So there was a rebound in consumption and consumer spending, and we saw a rebound in the non-manufacturing PMI in September from 47.5 to 53.2. Okay. As for the Caixin PMI, it more or less shows the same picture, but the manufacturer PMI fares better than the official PMI. The Caixin China manufacturing PMI held steady in September after a slump in August, also impacted by the COVID-19 outbreak in August. Yet the services PMIs also saw a strong rebound in September from 46.7 to 53.4, driven by a solid rise in sales and output amid the contained COVID-19 situation. So what is the fourth quarter outlook? Okay. Let's take a look at PBoC's monetary policy. We expect the People's Bank of China to stick to a normal monetary policy that will be prudent, flexible, targeted, and reasonable. We expect the PBoC to keep the bank's reserve requirement ratio, the RRR, unchanged in the fourth quarter before delivering another 50 basis point cuts in the first quarter next year. So there's no imminent pressure for the PBoC to cut reserve requirement ratio again before the end of the year, as it has already cut the RRR in July this year, releasing about 1 trillion yuan in long-term liquidity into the economy. The Central Bank of China will still have various tools to keep liquidity reasonably ample and enhance stability of total credit growth, mainly through open market operations such as repo and MLF, medium-term loan facility, to keep liquidity sufficient. Okay. For the fourth quarter outlook, we expect China's economic growth to continue to face more challenges in the fourth quarter due to a higher base last year, as well as rising raw material prices and global supply chain disruptions, especially a shortage of microchips and the latest power crunch, and also lingering pandemic controls in certain parts of China, and also uncertainty in the global environment. We believe central government's policy fine-tuning will give more priority to stabilizing economic growth, such as controlling energy consumption and diffusing financial risks related to the debt default by property developers. We expect acceleration in fixed asset investment in manufacturing and infrastructure sectors in the fourth quarter, and also reviving consumer activity. These will be the key drivers of the economy in the fourth quarter. So the third quarter GDP, we expect the growth rate to slow down to 5% in the third quarter, but for the full year, because of higher growth rate in the first half, we expect GDP growth of 8 to 8.5% for the full year, up significantly from the 2.3% seen last year. So overall, the fourth quarter, we have a mixed view. On the one hand, we expect more challenges or the existing headwinds to stay. But on the other hand, we also expect more policy support, more policy fine-tuning, and also acceleration in fixed asset investment to prop up the economy. Okay, our view on the renminbi, we expect the yuan to move both ways to display two-way fluctuations. Actually, in the third quarter, the yuan was stuck in a very tight range between 6.42 and 6.5, very tight range. Going forward, we expect the policy divergence between China because of the slowdown, economic slowdown. We expect more loosening monetary policy in China. Yet, for other major economies, their central banks are considering raising interest rates. So this policy divergence would likely prompt capital outflows from China and may bring downward pressure on the yuan. Besides, higher electricity prices may push up prices of Chinese exports, and the resulting reduction in the trade surplus may also bring about depreciation pressure. Yet we don't expect a sharp depreciation in the yuan exchange rate, in the renminbi exchange rate. The exchange rate is expected to remain in the 6.4 to 6.5 range in the fourth quarter, and will continue to display two-way fluctuations. Okay. Here are our fourth quarter index targets and also the ETF picks. Okay, for Shanghai Composite Index, we expect a range of 3,400 to 3,700. Very much the same, similar to that in the third quarter, because our view on the economy, we have a mixed view. So it will be neither too positive nor too negative. So we are maintaining a neutral stance on the index. We recommend buying of the A50 ETF 2822 at $7.50 Hong Kong dollar, and we set a target of 19 Hong Kong dollars. Stop loss recommended at 1650. As for the CSI 300 ETF, ticker code 3188, we recommend buy at $59 with a target of 63 Hong Kong dollars and stop at 57. So we expect rather tight range, tight trading range on the ETF in the fourth quarter. Okay. As for the Hang Seng Index, we believe it has bottomed out in early October after falling to 23681. So we expect a rebound in the fourth quarter after the sharp sell-off in the third quarter. We expect resistance around 26,800. So this is our index target range in the fourth quarter, 2361,681 to 26,800. We recommend to buy at $25 for the tracker fund 2800 with a target of $27 and a stop at $24. The Hang Seng Index, we also believe it has bottomed out at 5,825 in August. So the tech index actually bottomed out earlier, 1 month before the Hang Seng Index, or 1.5 months before the Hang Seng Index. Even the Hang Seng saw a new low in early October. It did not fall below the 5,825 bottom seen in August. So we expect a rebound to 6,750 in the fourth quarter. Okay. Between the two tech index ETF, 3033 and 3067, we recommend to buy at 6 Hong Kong dollars for 3033 and with a target of $6.80 and stop at $5.60. Okay. For 3067, we recommend buy at $12.50 with a target of $14 and stop at $11.80. Okay. Just now I mentioned we'll do a technical analysis on the tech stocks. Namely, we'll cover ATM, X, and J, Alibaba, Tencent, Meituan, Xiaomi, and JD. Okay, Alibaba is the weakest among all the 5 tech stocks that we're going to cover, because you can see that its share price hit a new low of 132 in early October, while the tech index actually has bottomed out in August. So it saw a new low. But after seeing the new low in early October, it staged a rebound, and now its share price is testing the resistance of the 50-day moving average, which is the blue line here, the 50-day moving average. And its relative strength index, after staying below the 50 level for 3 months, finally it rises above 50 in early October. So we expect the rebound to continue in the fourth quarter for Alibaba, and we expect it to be able to breach the resistance of the 50-day moving average. Currently is at around $164. So about 164, the resistance level would be 170 and 185. Whereas the support level is expected to be around 150. Currently, its 10-day moving average and 20-day moving average lies at around 150. And if it fails to hold above the 10-day and 20-day moving average, the next support level would be 135. Okay, so if there's any correction in future to close to 150, we reckon that would be a good entry level, and then you can eye on 170 and 185 as the upside target. Tencent share price bottomed out in August together with the tech index, and since then has rebounded quite strongly in early September to close to 530. And then it came down again in the sell-off in September, yet it found support at around 445 Hong Kong dollars. And now it was rebounding again. So we do expect it the share price to test the 100-day moving average again, which is this line. This is the 100-day moving average. We expect resistance around 530. And if it manages to rise above 530, the next resistance level would be 550, around this level. Support level, now is 3 moving averages, 10-day, 20-day, and 50-day moving averages all lie around $465 to $470. So we expect strong support at 470. And then the next support level will be 445. Okay, so in the short term, if there's a correction towards 470, this is still be a good entry level, and the upside target would be 500, above that 530 and 550. Okay. Meituan share price also bottomed out in August at 183.20, and since then he has rebounded, and its relative strength is outperformed that of Tencent, because Tencent share price is still trading below the peak seen in early September. Yet Meituan has risen above the rebound, the high in early September, as well as the 100-day moving average. So we expect its share price to test the 250-day moving average, which is around 292. If it manages to rise to breach the resistance level of the 250-day moving average, we see another more upside. The next resistance level will be around 320 here. Okay, support level would be 250, and then the next support level is 230. Okay. Among the 5 tech stocks, ATMXJ, Xiaomi is the weakest performance. Its share price bottomed out, hit a new low in early October, as Alibaba did. It dropped briefly below $20, hitting 1986. Yet the rebound, if you compare with Alibaba, the rebound was less strong compared to Alibaba. Currently, it was still below the 20-day moving average. So we expect resistance around the 20-day moving average, which currently lies at $22. And above that, the next resistance level is $23.50. The short-term support will be the $19.86, the recent low, and below, if it drops below $19.86, the next support level will be $18.20. Okay. JD, its share price also bottomed out in August. So among the 5 tech stocks, ATMXJ, we noticed that Tencent, Meituan, and JD, which are the outperformers, the share price bottomed out in August and then rebounded in September. But among Tencent, Meituan, and JD, Meituan was the outperformer. Its share price has risen above above the highs seen in September, early September. For JD, it's still kept by the recent high, around $325 seen in September, early September. So the 330 would be the next resistance level. Above 330, the next support, resistance level is $355. Support level expected at 290, because now the 10-day, 50 days, and 100-day moving average all lie around 290. And below 290, the next support level will be 265. Okay. So I noticed there are quite many questions. So we will start the Q&A session immediately to see what questions. All the recommended health tech stocks had dropped by nearly 50%. What's our look on this speculative growth sector? The health tech stocks, I think you are referring to Ali Health, Ping An, Good Doctor, and JD Health. I think from the recent price performance, they will still lag behind ATM and J. So I think only after ATMJ rebounded certain to a higher level, then we may see some switching out of those tech stocks into health tech stocks. Currently, I think they will still underperform. What will be the impact of power crisis on the Hong Kong market? Actually, manufacturing stocks that have facilities in China will be impacted. So we noticed that a lot of the manufacturing companies listed on the Hong Kong market are pressurized by power crunch. Whether there's a short-term solution to the power crunch, we're not so certain. Although the central government has pledged to increase coal supply so as to solve the power crunch, but we do expect because of this, the recent flooding, heavy rainfall in Shanxi. Shanxi and Shanxi are the two major coal producers in China, two coal-producing provinces in China. So we expect disruption to coal supply. This power crunch may continue into the early next year. So that we don't see an imminent solution to power crunch, and those manufacturing companies will continue to be under pressure in the short term. What is the risk? What is Evergreen fallout? As I explained earlier, the Chinese government will manage this Evergreen crisis, but a breakdown of the company is possible, and the disposal of its assets. So the company is very likely to be break down and for sale of some of its assets. Yet for the bondholders, they may see a haircut in their bond investment in Evergreen. For property, for the share investor, equity investor, they will also suffer big losses because of the huge drop in share price in Evergreen. Yet the Chinese government, we think they are more mindful of the impact on the home buyers of the property projects of Evergreen. So the government will implement measures to make sure that those uncompleted projects will be delivered. And some of the projects may be sold to other property developers. So as the other property developers will take up those projects and complete and deliver to those home buyers. Okay, for the time being, we still recommend against buying property developers because of concerns of hidden debt problems among other property developers. Only the safer bets are those companies with state shareholders, such as China Overseas Land, COL 688, and CR China Resource Land 1109. Okay. What's the outlook for Ping An? Because of its exposure to the property the bonds issued by certain property developers in China, I'm afraid Ping An has to make hefty impairment in its investment. So, and this has been reflected in the share price, in the drop in the share price. But we do expect that it has already priced in. So it's with the interest rate expectation of high interest rate, actually it will favor the insurers. So lately we noticed that other Chinese insurers are posting better performance, such as China China Life and other Chinese insurers. But Ping An, it will underperform China Life this time round because of its exposure to Chinese property developers. Okay. Okay. Could we comment on Ping An? Just now I have commented on 2318. I expect it to underperform other Chinese insurers because of exposure to the property sector. As for Chinese major banks, we still recommend not the state-owned banks because there may be policy pressure on them to handle the debt problems of property developers. We recommend two banking stocks that are namely China Merchant Bank 3968 or China Postal Bank 1658 instead of 1398 and 939. But we do expect the share price to remain stable, 1398 and 939, but we don't expect a lot of upside in the share price. The dividend yield offered by 1398 ICBC and CBC are quite resilient. Yet therefore we don't expect much downside. Yet on the other hand, we also don't expect a lot of upside. If you look for price appreciation, better suggestion will be better target would be China Merchant Bank 3968 and China Postal Bank 1658. Okay. OCBC Tech Fund. I'm not in a position to recommend this tech fund. I think it's listed in Singapore. Yeah. So our Singapore colleague will reply this question. Okay. Okay, I can see. There are questions on Tencent and AIA. Tencent, we expect the share price to continue to rebound. There's still some upside, but the uncertainty surrounding online games in China, there will be more supervision and regulation on online games industry. That's for sure, and that will limit the upside of Tencent. So we expect Tencent, it may be able to rebound to around 530 or even 550, but it's quite unlikely to see its share price to rise back to $600 or $700 seen in early this year. AIA a bit head scratching because it underperforms other Chinese insurers lately. In the past, it used to be the outperformer, but lately it underperformed. We are still trying to find out the reason why it underperformed. Because on the one hand, rising interest rates would also favor, it will also benefit from rising interest rates. and also the expansion in its business network in China. The outlook remains upbeat. We remain upbeat on its business expansion in China, but recently its share price underperformed. So as long as it holds about 82 Hong Kong dollars, I think it should be okay, despite the fact that it underperforms its peers, its Chinese peers. Okay. Is this a good time to buy SMIC in view of semiconductor shortage? But it does not benefit from the semiconductor shortage. Its share price actually underperforms. But at this price level, I think the valuation is attractive. So if from a longer term perspective, I think is a good time to buy SMIC, but investors have the patience to wait for the semiconductor, because it's not seen as a beneficiary of the shortage. So we would need to wait for the shortage to be over until we see resume interest in its in the shares, in SMIC shares. Okay. Peter asked for my opinion on HSI Tech ETF. Just now, you can refer to my recommendation. We expect the Hang Seng Tech Index to rebound in the fourth quarter. Can we go back to the PowerPoint? Yeah. Okay. We expect after the huge sell-off in the third quarter, we expect further room for rebound in the fourth quarter. So I'm looking at a target of 6,750. Currently, it's trading at 6,380. So there's another at least 5% upside, close to 6,750. This is our recommended strategy on the two tech ETFs, 3033 and 3067. Okay. With the current market sentiments, could you comment on stocks related to the airports, Shanghai, Beijing, and the airlines? Actually, we noticed that the share price starts staging a rally among the aviation companies. All the three Chinese airline operator, the share price is rallying, and even Cathay Pacific, its share price is also strengthening recently. So I think this reflects the expectation for further recovery in travel in China as the COVID-19 is under control. There's talk of opening up between Hong Kong and China, the travel between Hong Kong and China. So I think we are upbeat on the airline aviation sector, including the airports. But we do expect airports because they are less sensitive to the airline companies. So we expect the rally to be more profound among the airline operators, such as Air China, Eastern Airline, as well as China Southern. Could you provide an outlook for silver? Oh, silver, okay. I can also talk slightly on gold. Because of expectation of Fed tapering, as well as rate hike as early as 2022. So this will strengthen the US dollar, which will be unfavorable to both gold and silver. And silver is also there's more industrial application for silver than gold. But in view of the current supply chain disruption and also power crunch in China, we expect the manufacturing activities will have an impact on manufacturing index. Hence, will also impact the industrial application for silver. So silver, we are not so positive. We are slightly negative on both gold and silver. For gold, we expect support level at 1,680 US dollar, at 1,680 at the 1,680 level, and resistance we expect to be around 1,800 to 1,850. Could you advise on outlook for PetroChina 857 and Sinopec? What price could we consider accumulating? PetroChina will benefit from expected higher oil prices. So that is one positive. And the other positive is PetroChina is also venturing into new energy. So its share price outperforms CNOOC and Sinopec because of its expected involvement in new energy. A good entry price would be around 390. Target 440. Stop loss suggested at 360 for 857. As for Sinopec 386, it underperforms that of PetroChina. We expect support around 385. So if one wishes to entry price would be suggested at 385. Target $4.30, and stop loss at 370. But it will underperform 857 in view of the strength, the strength in the share price. Okay. Again, question on Ping An, which I have already answered. Okay, what are your top individual stock picks in the Hong Kong market? Actually, in my last Chinese seminar, I suggest investors to pick stocks that will receive policy support rather than stocks and try to avoid stocks that have policy risk. Stocks that will come under policy supports are mainly these environmental protection companies. So recently that we saw correction among the environmental and new and clean energy companies. So investors can still look at 956 new Suntian green renewable energy 956, and other stocks such as Everbright, China environmental 257, and also its subsidiary 1857. These are the outperformers lately because of expectation of more policy supports towards the environmental protection sector as well as clean energy sector. Okay. What is my view about Alibaba? Is considering that it's also focused on e-commerce and cloud, similar to Amazon. Before this policies shift, because recently, if you may have read in the news that China is encouraging cloud service at the state-owned enterprise to switch to state-owned cloud service provider. So I think this is unfavorable to Alibaba because of the policy shift to state-owned cloud service provider. As for e-commerce, we do expect competition to get more intense, and also the supervision on antitrust supervision will continue to to add uncertainty to the outlook of Alibaba. But in terms of share price movement, as I showed just now, its share price after the sell-off in the third quarter, there's room for rebound. So we are looking at opportunity of rebound, but not kind of sustainable or long-lasting rally as seen in the past. Okay. Between Baba and Amazon, which is better by now? Still Amazon, because just now, as I have explained, Baba is still facing uncertainties from policy supervision, as well as this policy shift from to encourage the state-owned enterprise to switch to state cloud service provider. Okay. Could you please share my latest view on Hutchison, this 1-3, Hutchison Pharmaceutical? Very disappointing. Share price, I think one should, its share price holds about $57 to $67, but now it's broken the support. This is broken downwards. The support level of this price range, and saw new lows at $48. If one has not held the shares yet, I will recommend to avoid for a time being, unless we see strengthening in the share price, or otherwise I'm afraid that the share price will continue to hit new lows. After breaching the $53, $54 support, now this $53, $54 support level will become the resistance level. So for those investors who have not cut loss, who are still holding the shares, who bought the shares at higher price level, may look to cut loss if the share price rebounds to 53 to around 54 Hong Kong dollars. As for 1658, the China Postal Bank, just now we like China Postal Bank and China Merchant Banks. In the first half, its earnings grow faster than the other state-owned banks such as ICBC and CBC. So in terms of share price performance, it saw support around 505, and now we are expecting the share price to rise to 550. If it manages to rise above 550 and stay above 550, we are looking at a medium-term target of $6. Okay, so we are looking at the price range between $5 Hong Kong dollars and 6 Hong Kong dollars, with near-term resistance at 550. If it manages to rise above 5 and hold above 550, then it's very likely it will test the upside resistance at $6. Okay. What is the growth of insurance and banking sectors in China? Where is the question? What are your thoughts on China EV players? still optimistic because over time, we think the few vehicles will be eliminated. So in future, there will be more electric vehicles to be produced, not only in China, but as well as throughout the world. But for the new players, the so-called 新势力, Li Xiang, Neo, and Xiaopeng, we are not so sure because of we prefer the more established players such as BYD 1211 and Great Wall. We favored BYD and Great Wall to the new forces, the so-called new forces in EV manufacturers. 1211 BYD actually saw a breakout recently after the consolidation in August and September. So we saw a breakout Friday, share price rising above the 50-day moving average again. We expect its share price to test 255 and to 290 in the short term. So we are upbeat on BYD as well as Great Wall. Great Wall also saw a breakout in its share price on Friday, rising above the 50-day moving average again. So we expect the share price to test the resistance around $36. Support is seen at 32. So for Great Wall Motor, one can buy at around 32 with a target of 36. And for BYD, the support level is seen at 255. Upside target 285 to 290. Yeah, what's your view on Charlie Munger accumulating more Baba shares? It already has a short-term impact. It gives a boost to Baba shares. Just now, as you can see, Alibaba's share price rebounded quite strongly lately in Hong Kong, very much because of the news that Munger is accumulating the shares. But how long will this accumulation of shares, will his buying will continue, remains uncertain. So I will tend to have a more reserved view on Alibaba and expect the recent rally is a technical rebound instead of the start of a new uptrend. Okay. Li, Niu, and Xiaopeng. As I have explained just now, I favor the more established the old forces compared to the new forces. But among the three, I would prefer Li Xiang, because with one model, it sells better than Niu and Xiaopeng. And in future, with the launch of more new models, we think Li has a more competitive strength against its rivals if it with more new models launch. Okay. Okay. Jim A. Dak asked whether the target price for the ETF is for the fourth quarter. Yes, the answer is yes. It's for the fourth quarter. because I will conduct this webinar every quarter. So my index and also ETF picks would be valid for the current quarter. Okay. Let's come to chat to see what question would you 3033 and 3067, which would you recommend to buy? 3067 has a lower expense ratio, but 3033 is more liquid. So it depends on if you on short-term trading perspective, I would recommend 3033. But for if you are meant for longer term holding and is mindful of the expense ratio, then I would recommend 3067. This is a good question. Although not related to the Hong Kong and China market. From investment approach perspective to ride the uptrend wave, should we do more in leverage options for upside, or should we accumulate stocks like Amazon and Google? Now I think I would recommend personally, I would recommend using options, leverage options to ride on the uptrend wave, because one can be more flexible and there's leverage. So because I would recommend for a stock accumulation, if US stock is concerned, only when you see more than 5% correction from the peak, maybe 10% correction, it would be good opportunity for accumulation. If accumulation is concerned, you wait for any 10% correction in the US market. But since it's so resilient, in view of the strength of the US market, it's quite rare for us to see 10% correction in the US indexes. So one has to use options for short-term trading, and also to on the leverage to get better returns, to maximize on the return. Okay, let's go back to the question part. This question, I think our Singapore colleague will help answer about cash plus account. Our Singapore colleague, please take note and answer Annalise question. Why 883 and 857 don't rise even oil prices have gone up? Sometimes share price will run ahead of earnings or news. So expectation of higher oil prices in my point of view, have already been reflected in the price rally in CNOOC and PetroChina. So now they are in a consolidation phase. But as there's expectation that oil prices will continue to rise in future, some are calling $90 Brent oil prices, or even 100. Now the oil bulls are projecting $100. So I do expect 883 and 857 to continue to their rally after the consolidation in the short term. Okay. Have bank stocks such as ICBC, CCB, and PBoC bottom out? I think the answer is yes, because interest rate, with the expectation of a high interest rate, and also the fear, the default fear, I think has been digested by the market. At a time, investors are worried that this Evergreen default may evolve into a some kind of systemic risk, but so far it's contained, and I do think banking stocks, their share price have bottomed out. What about Baidu? Okay, let's look at Baidu. Give me a few seconds. I'll look at the chart. 9888. Its share price is similar to the performance, similar to Tencent, Meituan, and JD, but not as strong as Meituan. Its share price has bottomed out in August and rebounded quite strongly in early September. Then saw a correction in late September, now rebounded again. I do expect its share price to test the resistance of the 100-day moving average around 168 to 170. Okay, there was also the high seen in early September. So I think the rebound will continue, looking at 170 target. If it manages to rise about 170, the next resistance level would be around 180 to 182. Okay. James Teo asked about Sinovac, which I have already answered. Geely Dongfeng, okay. Target price for Geely this year. Geely, in terms of car sales, it lags behind that of BYD and Great Wall, and it's very likely it would not be able to meet its annual sales target. So there's a risk that it may have to, needs to revise downward its annual target. So I target for 2021 at best, I think is 27.50 Hong Kong dollars to $28 at best lah. This is the at best target for 175. Geely, Dongfeng. Sometimes investors need to pay attention to its price pattern. It used to rally very sharply and then saw sharp correction thereafter. Like in early September, its share price rallied from 650 to 850 within 2 to 3 weeks time. And then after peaking around 850, wow, there was a sharp correction. Its share price corrected to around 660. So it's a inverse V-shaped kind of pattern. Now it's starting a rally again. So beware of the quick rally. Sometimes it will rally very quickly and strongly, but then once it completes the rally, it will come down also very rapidly and sharply. So this is the price pattern I noticed for Dongfeng 489. Resistance level is expected around $8. Okay. Any comment on E-High? E-High, okay, wait. Because of the now the view on Haidilao is not as upbeat as in the past, because investors have concern about the expansion strategy of Chinese catering or F&B companies such as Haidilao and Shabu Shabu by opening more new restaurants to drive revenue growth. Yet the same-store sales disappoint. So this has reflected in the sell-off and also the lowering the lower valuation in those stocks. And E-High, because it's in the supply chain of Haidilao, is also impacted by this change in valuation as well as the view towards the sector. But yes, dropped quite a lot. So I think its share price has formed a triple bottom already, and now is staging a rebound, a technical rebound. First resistance level is at the $100 49. If it manages to rise above 49 and stay holds above 49, the next target rebound target would be $53. So 49 and 53. Okay. Okay. One last question. Thank you for so many questions. This time round, we have more time to answer your Q&A. But since now we are approaching 3:30, let's answer the last question. Okay. Do you think the Chinese government will adversely affect the EV market? I don't think so. They are only raising the subsidy threshold as the EV has improved on their technology and the battery strength. So I don't think the Chinese government will adversely affect the EV market. On the contrary, we do expect continuous policy support from the government, as it is the long-term objective of the Chinese government to promote the popularization of electric vehicles, which is essential to cutting carbon emission in the long term. Okay, so thank you for your time listening to our presentation. I will be expecting to see you again next year in the first quarter of 2022. Wish you all a happy weekend. Thank you.